Miami Condo Mondays is a live podcast on the first workday of the week at 4 p.m. South Florida time. The program features former journalist and current Wall Street consultant Peter Zaleski of the Miami Condo Investing Club and former lender and veteran condo broker Jenny Huertas of CVRRealty.com. Recorded weekly in greater downtown Miami, this one-hour discussion will provide a refreshing and sometimes controversial perspective on the state of the South Florida condo market from a pair of seasoned real estate professionals who do not always agree. The program won't tell you what to think about the South Florida condo market, but will give you something to think about before buying, selling, taking listings, or financing units. This podcast is not authorized by the Miami real estate industry and will quite possibly annoy many of its figureheads. Welcome to this week's episode of Miami Condo Mondays, broadcast live on the social media accounts of Peter Zaleski and Jenny Huertas.
Happy Monday, Miami. This is Peter Zaleski. I'm a condo consultant. I'm also the founder of the Miami Condo Investing Club. If you're watching this podcast, you are tuning in for Miami Condo Mondays. Normally, we do it at 4 o'clock Eastern Time. We're making an exception today. Why? Well, I happen to get a free ticket to see the New York Jets versus the Miami Dolphins football game, and a Monday night game is being played at 7:15. Who in the right mind does anything at 7:15? But anyways, I was fortunate enough to ask that my co-host, Jenny Huertas from CVR Realty, check out her website, cvrrealty.com. I asked her if she could move it forward. Instead of doing it at 4 o'clock, we're actually doing it at 1 o'clock. We didn't want to miss one of our podcasts, which we began back in May, and we're going to give you some straight talk. What are we talking about this week? We are talking about Miami, for the second year in a row, was ranked the most overvalued residential real estate market in the world. Not Florida, not the United States, not North America, but the world. We're talking everywhere from Hong Kong to New York. We're talking Toronto or Vancouver, all the way down to Buenos Aires. Basically, Miami is the most overvalued market, and Jenny and I are going to discuss the report, which comes from UBS, and then we're going to get into some of the details, we will not tell you what to think, but we'll give you plenty of stuff to think about. So, Jenny, how's it going? Happy Monday. Thanks for moving up the podcast early so I could go out there and see the Miami Dolphins football team hopefully win, but the way the season's going, they're probably going to blow it.
Happy Monday, and I hope that they win. Have a great game. It's gonna be great because it's against the Jets, like the super enemies. So yeah, I'm happy to be here. I can't believe it's been 4 months already since we started doing this.
Yep, it's been 4 months, and also too, if anybody doesn't know, you might be watching this anywhere around the world. The reason we're sort of focused on, I'm focused on this game. I don't typically like to go to NFL games. I don't find it that interesting. I'd much rather watch it on television and be doing something else rather than sitting there because the stoppage between plays and stuff. But the only reason I'm going is that there's plenty of New Yorkers that over the years, in fact, going back to the 1920s Florida land boom, plenty of New Yorkers come down here. So they make their money in New York and then they come down here and they burn it or they piss it away. So as a result, you have this whole contingent of New Yorkers who live in Miami who basically are fans of the team called the New York Jets. So typically, and this will be my third Miami New York Jets game. Typically, there's more excitement in the stands when the fans are fighting, the New York fans versus the Miami fans, and actually on the field. Both teams suck. Both teams have lost their first 3 games, so it is going to be a piss poor showing. Maybe that's why the NFL is starting at 7 o'clock, 7:15, rather than the normal start time sometime after 8 o'clock, because it's kind of it's like a junior varsity type of game. But still, I'm going because I want to see the fights in the crowds.
Good reason.
So, Jenny, talking about fights in the crowds, that's a perfect segue into getting into this brand new report. It comes from UBS. UBS is an investment bank out of Switzerland. They come out with a report every year. It's called, let me give you the exact name, just so we can talk Turkey, as they say. It's called a UBS Global Real Estate Bubble Index. Effectively, what they do is they take a look at rent, they take a look at valuations, they take a look at the market conditions, and then they figure out how close or how out of whack a market is. And for the second straight year, because back in 2024, Miami is ranked the most overvalued housing market, residential real estate market in the world, and we repeat it again. So we are defending champs. And what this UBS Global Real Estate Bubble Index says Let me just tell you really quickly. I'm scrolling down. I'm looking at the report, and it talks about bubble risk. It talks about what's going on with the risk, but it also talks about what is a bubble. A lot of people like to talk about the market's it's overinflated, it's underinflated, yada yada yada. Sell side brokers will tell you, well, the Miami is cheaper than anywhere else in the world. That's why everybody comes to Miami, because they can get things at a discount. If they were in New York or San Francisco, they wouldn't get as much for their money. Blah 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 blah. So what UBS tried to do is they try to cut through all that and make it apples to apples. And let me kind of give you, Jenny, some of their overview. So this is what they say in the report. They call it identifying a bubble. I'm just going to read a couple graphs from it, Jen, then I want to get your response. It says price bubbles are reoccurring phenomena in property markets. The term bubble refers to a substantial and sustained mispricing of an asset, the existence of which cannot be proved unless it bursts. It goes on to say, but historical data reveals patterns of property market excesses. Typical signs include a decoupling of prices from local incomes and rents, which we've been talking about a lot, Jenny, how the prices are here and the rents are there, and it makes more sense in many cases to rent rather than to own. So that's point number one. The description also says that and imbalances in the real economy, such as excessive lending and construction activity. Now, we got a lot of product going on. We got markets like Sunny Isles Beach where the number of condo units either delivered or under construction is almost 1-for-1, if not greater, versus the actual residents. Now, why is that? That's because we are a community where a lot of people come down. They spend 6 months of the year or so. Maybe they spend weekends. Maybe they buy for the purpose of renting out Airbnb. And as a result, we tend to build more inventory than sometimes we actually need. A lot of people talk about, well, there's not enough housing, not enough housing. Well, actually, I would argue there is enough housing, especially after 1 million people died during the pandemic. There's enough housing, but what's happening is much of the housing is in the hands of either corporations that have purchased it through REITs and or investment groups that have purchased it for Airbnb purposes, i.e. short-term uses. And then you also are going to have the properties that maybe somebody living up in New York, and I'm mentioning New York because tonight's game with the Jets, but maybe somebody up in New York, their parents moved down here, they bought a unit, and they're up in New York City. They have no intent of coming down here, and they're simply going to rent it out. And once the parents passed or whatever the case may be, these people ended up with the unit, and they're like, screw it, let's just go ahead and rent it. So that would be my point. Jenny, let me continue on. It says typical signs, including a decoupling of prices from local incomes and rents and imbalance of the real economy, such as excessive lending and construction activity, as mentioned. It says the UBS Global Real Estate Bubble Index, it gauges the risk of a property bubble on the basis of such patterns. The index does not predict whether and when a correction will set in. A change in macroeconomic momentum and a shift in investor sentiment, plus a major supply increase, could trigger a decline in home prices. So that's another way of saying a black swan. Something that scares the heck out of everybody, and all of a sudden they all run for the exits. What are some examples of black swans? Well, we saw a black swan with the pandemic. When the pandemic first hit, a lot of people were dumping stocks. They were actually looking to sell their real estate initially. They were also trying to get into cash. They just wanted to get their hands on something because they didn't know where the market was going to go. Another black swan was when Lehman Brothers, the former investment bank that got shut down and ultimately triggered what would be called the Great Recession back in September of 2008. It sent everybody running for the exits. So I guess what I'm saying is the UBS report is saying, listen, if there is a black swan or if there's some sort of change or something big, and I would remind everybody there's negotiations going on right now in Washington, D.C., where the federal government might actually shut down. If the Republicans and Democrats can't agree upon something, we could be in for prolonged shutdown, which would lead to all kinds of the elimination, hopefully short term, of all kinds of services. But more likely what the Republican Party has said is they're going to be mass firings. So I'm not saying that's a black swan, but it's something big like that that can trigger something to sort of occur. Maybe it could be something like a war, an invasion, maybe something like a devaluation. Maybe for some reason, there's an announcement and everything gets devalued. These are the things that basically come out of nowhere and spook everybody, and they automatically have to change their base case scenario. So what this report, Jenny, is saying from UBS is saying, if we get some kind of trigger, these are the markets that are likely to get hammered. Why? Because the valuations versus the potential rental income and local economy and how it's operating is so out of whack. I'm not going to say the 1% rule, which I like to talk about and not everybody agrees with. 1% rule is your rent ought to be 1% of the value. So a $100,000 place should get $1,000 a month in rent. A $1 million place should get $10,000 a month in rent. Our numbers are way out of whack. We get nowhere close to that. But I would sort of argue, these things are sort of one and the same. Jenny, any immediate reaction to what a bubble is by how UBS is defining it? How often have you heard about bubbles, and how long do they, or how common is it for them to actually burst?
Wow, that's a long question. Well,
all right. So give me your response to when you hear bubble. Do you think it's BS? Do you think it's marketing? Do you think it's Chicken Little doomsday, or do you think there's potentially something to it? How do you react when you hear bubble?
No, it is. This is an investment bank. It's not coming from National Realtor Association or anybody like that. It's economics, and they're out of whack. We've been talking about this for the last 4 months, in public every week, and so we are following when this. We know the bubble exists. We just don't know when it's going to burst. We experienced in 2008, when we had to live through it, and when it all happened here. I think this time is so different, and I'm not trying to sound like a marketing person or anything like that, but I think Miami, 20 years or almost 20 years apart, is a city where it became expensive. It's not anymore a great deal comparing with Hong Kong or comparing with other London or anything like that. We're getting right there. So it became an expensive place to live, and where more and more the locals are pushed to rent or move away to a more affordable towns in the same state. So yes, I think it makes a lot of sense why Miami is getting that defending champion position. But I also think it reflects what is happening. I think it reflects that 1%. I'm not talking about your 1%. I'm talking about the 1% of the population that actually don't care. I want my 20 million penthouse. No, not even a penthouse, a lower penthouse. A penthouse probably 30 or $40 million. And I don't care because I have the money and I can afford it. So this is a phenomenon that we have here in Miami. Because if you compare it with places like, for example, in the United Arab Emirates, Dubai is a destination. Miami is a city where actually local people live. But we also have a huge population that comes only for a few months, second home buyers, which are the rich ones that can afford to have one place here and their home place somewhere else. So Miami is different, and I can see why there's difference in the prices and why it would be in first place right now for that. So that's my opinion on the bubble.
Okay. We're going to get into some of the details. We'll talk our way through it. I'm going to tell you some of the rankings. There's 21 markets there were 21 markets that were ranked this year, and all of them have been assigned like a color code as to which ones are so out of whack. So you're going to have red, you're going to have yellow, you're going to have a pink, and then you're going to have like a gray to mark these 21 markets. And we're looking at everywhere from Miami down to Sao Paulo. Sao Paulo is actually the best market of the 21 that are studied. It has very little risk. In fact, it has to give you context, Miami comes in at 1.73. This is the index score that UBS has created, just like we do the Miami Condo Cliff Index, where we're tracking the market to give you real time. UBS has set up an index, and it's called the Real Estate Bubble Index. So they come up with it, they spit it out, and they're able to compare apples to apples for any market around the world. So Miami comes in at 1.73. Where does Sao Paulo come in? They're negative 0.1. So what that means is Sao Paulo is actually undervalued. Miami is overvalued. Big dramatic difference. So anybody out there looking to park some cash, Sao Paulo is the market you want to be going to for residential. according to UBS.
Yeah.
And Miami is the market you want to avoid right now until potentially the bubble busts. But let me just hit on some finer points before we go into some of the details. Let's go worst to best. Or excuse me, let me rephrase that. Let's go best to worst. Because Miami's going to be Miami will be the worst. There's no question. Again, 2 years in a row. But remember, I was a journalist for a long time, 13 years. In the journalism world, they have a saying: three is a trend. So 2 years in a row, if we hit one more year and be in the top market or the worst market for overvaluation, then I think it would be significant. But so we're going from the best markets, which means the lowest risk of bubble, to the worst markets, which means the highest risk for bubble. So, Jenny, Sao Paulo is the best market of the 21 that have been studied on all continents. Well, effectively on most continents in the world. Second best market is going to be Milan. So while Sao Paulo is negative 0.1, Milan comes in at 0.01. So it's basically right there where you want to be. So if you want to look at a market that's kind of right in priced correctly, it would be Milan. Jenny, you go to Italy. You've been to Italy. Any response? Do you know Milan? Can you talk about Milan as we sort of proceed and make our way through the list?
Yes, definitely. I'm surprised that Milan is on the best markets because for Italians it's super expensive. So that's another issue. Maybe the numbers there, but for locals, it's a different story. Milan obviously is the most industrial city of Italy, even though it's not the capital, but it's where the money is made. So yes, it's expensive for them, but it's not so expensive for people that was buying in Dubai or even in Miami. So for them, it's affordable, but it's not affordable for the locals. I mean,
Makes
compare
sense.
what they make money, or the money they make. It's the same thing with Miami.
Okay. And I should mention in this study, they do talk a lot about primary users. So these are the people who are actually living in the places rather than the out-of-towner who's parachuting in, buying some real estate and spending a couple of months here. So, Jenny, the third best market or the third market on the list, working our way up. Remember, Miami comes in at 1.73. This is the
Okay.
risk factor. This is the highest. So anything lower than that is going to be in a much better situation. And we said Sao
Mhm.
Paulo comes in at negative 0.1. So Sao Paulo is actually undervalued. Milan comes in at 0.01. So, it's right there where it's supposed to be. And then we're going to run into Paris. Paris is overvalued, but it's overvalued by very little. It comes in at 0.25. Again, Miami, 1.73. Paris, 0.25.
Wow.
Jenny, you travel around Europe. You've traveled the world. Any immediate reaction to Paris? I mean, it is a global destination. A lot of people sort of go there. Are you
Yeah.
sort of surprised that the pricing is kind of falling in where it is, or does it have to do with maybe the system in France where it's a little bit, it's less capitalistic than what you're going to find here? Don't get me
Yes.
wrong, it's capitalistic, but it's not the savage capitalism that you get in the United States.
Absolutely. That you just got a partial answer on that because it's a different system, and there is a lot of people that actually live there full time. There are places that are for vacations, but I think they have more control over those places. And still, it's expensive again. It's expensive for locals, but it's cheaper for people that can actually afford places like that in main cities around the world, like Paris or Milan or other places. Yes, I agree with you.
Okay. Now, right there above Paris, surprisingly, we're going to get New York and San Francisco. New York and San Francisco are effectively comparable to Paris. Paris comes in at 0.25 according to
Wow.
UBS. New York City is 0.26. Then you get San Francisco. You always hear about San Francisco. Oh, it's overvalued. San Francisco. We're moving to Colorado. We're moving to Seattle. Well, San Francisco comes in at 0.28. 0.28 San Francisco, 0.26 New York, 0.25 Paris. Miami, 1.73. Um,
Wow.
Jenny, any surprises? San Francisco, New York. Remember during the pandemic, everybody fled those places, whether it was what was going on with the wear a mask and or it was taxes. And now it seems like the valuations, as much as New Yorkers like to bitch and moan about how expensive New York is, it seems like it's really kind of it's kind of on par with their local economies.
Yeah, that's actually pretty interesting because the people because of that, all this politics and all that, they say, oh my God, I'm not never gonna buy a place in New York or never gonna get a place in California. San Francisco, don't get me wrong, those places are still expensive. It's not affordable. I mean, it's not, the index is down there, but I don't think those places are affordable by any means.
But,
Which is
go ahead.
which is actually kind of even, maybe because the people flew and now people is trying to come back because they found that other markets were actually more expensive than they anticipated. And I know we're gonna get there, and I don't want to go ahead of you, but but Florida has certain things that make this issue worse, and therefore they are in the worst on the worst percentage. So yeah, I don't think that those places are affordable. But remember, we used to compare Miami with San Francisco and